very soon. Just wanna say hi to our guest here today and the audiences. We'll be starting in just a few minutes. Still having some audiences making their way here, but welcome to a AMA today on HashKey Global's official Twitter account. We have a really exciting lineup for our AMA today. So I'm really excited to be able to have this conversation. So what I will do today is I will give a quick intro of who our speakers are today, and I will let each of the speakers to introduce themselves. And after that, we will get into some really exciting questions. We have some really nice, we have a really strong guest here with us from really strong projects. So I think the conversation today will be really interesting. So I'll do a quick intro of all of our guests here today. So first up, we have Ben, the managing director of HashKey Global. We have Michael, the founder of CRV Finance, and Rita Liu, the CEO of RD Technologies. First of all, welcome for joining us today on our Twitter space. And I am Larry, the host of the Twitter space today. So just want to do a quick mic check. Ben, Michael, Rita, are you guys there? Can you hear me?
Yes, all good.
Yep.
Perfect.
Hey,
awesome. Appreciate it. Thank you so much. So then I guess let's dive right into it. So I wanted to so let's do it in this order. So Ben, and then Michael, and then Rita. Can you all come on stage and do a quick intro about yourself and the project you're representing? Ben, why don't you get started?
Yeah, sure. Pretty excited to be here. Just a little bit of background. So my name is Ben Elbaz, managing director over here at HashKey. As part of the founding team of HashKey back six plus years ago, and prior to that, I was doing my master's over at Stanford. Put together the university's largest blockchain working group, and then prior to that, I've been in tech and finance, working a lot in open source over the years. And just as a quick note, right? I think we'll get into it in this conversation, but I think from day one of the most important things that I was focusing on and what HashKey was focusing on is really about how do we create kind of a sustainable trading venue for crypto assets for the future, right? So I think there's been a lot of work on compliant exchanges and regulated exchanges over the years, but I think what's most exciting about what HashKey Global is trying to build is trying to build a next generation compliant regulated exchange that protects client assets while at the same time allowing clients to kind of trade the products and services that they're used to on other exchanges, right? Because you don't want to just have an exchange that's regulated and just has a high level of asset security, but you're not able to trade what you want and you're not able to make money, right? So HashKey Global is really trying to kind of build the best of those worlds, safe client asset, segregated custody, while at the same time giving clients the products and services that they want to trade.
Thank you, Ben. Thank you. And surely we'll be able to dive in a little bit deeper into that as we go down deeper into our conversation today. But before that, I would love to introduce Michael. Can you come on stage and give us a quick intro about yourself and CRV?
Sure. So I guess probably everyone probably knows, but I'm the founder of CRV Finance, which originally was a decentralized exchange for stablecoins. I mean, to exchange between similarly priced assets, but later it expanded to volatile pairs as well as we have a stablecoin and lending right now. And apparently stablecoin brings most of the revenue at the moment for the system. But before starting CRV, I actually first studied in Moscow Institute of Physics and Technology as a physicist, then did a PhD in physics in Australia, and after that worked as a software engineer at LinkedIn for a little bit, and founded a previous company, NewCipher, which is now actually doing TBTC together with Keep, and in 2020 started CRV.
Thank you, Michael. Thank you. And again, welcome to our Twitter space. I look forward to having our conversation. But actually, I just realized I forgot to introduce the topic of our Twitter Space today. So before I get to Rita, I'd just love to reiterate today's topic is going to be about exploring stablecoin innovations and global compliance. And we have a really strong a selection of speakers for this topic. We know Hong Kong has been making some really strong progression in the field of stablecoin, which I believe Rita will tell us more about. Of course, Michael, who just briefly gave us an intro about the work that Curve is doing with stablecoin. So today's topic is exciting, it's timely, and we have the right people here to give us a perfect conversation. So Rita, can you come on stage now and give us a quick intro about yourself?
Sure. Thanks, Larry. Can you hear me?
Loud and clear. Loud and clear.
Yeah. Hi, everyone. Nice to be here. I'm Rita, CEO of RD Technologies. We're a group based in Hong Kong, founded by a few well-known investors in this region in Web3 and Web2, including HashKey, and the former president of Hong Kong Monetary Authority. So we run a few businesses. One is a fiat challenger bank with SPF license in Hong Kong. And in the meantime, we are launching a stablecoin, starting with a Hong Kong dollar pegged stablecoin under Hong Kong's new regulatory framework. We just announced 10 days ago, about 10 days ago, that we're one of the first few batch of few companies that has got the approval to join Hong Kong MA's stablecoin regulatory sandbox. So we are just about to start this exciting journey of launching our stablecoin. So very nice to be here.
Thank you for being with us here, Rita. Again, congrats on the team and for making this progress in the future for futures of stablecoin in Hong Kong. So yeah, thank you for all of our speakers for making that quick intro. So I think now let's really quickly get into the first questions. We're going to divide today's session into two sections. The first one will talk a bit more about Curve and its overview and roadmap. And after that, second session, we're going to talk a little bit more about stablecoins and the regulatory landscape. So I'll start with Michael. I got a few questions for you. Hope you're ready for it.
Yes.
Perfect. So my first question for you, Michael, would be can you give us an overview of Curve's key developments and achievement over the past 1 or 2 years? And what is the team currently focused on, and what are your top priorities?
Yeah, sounds good. So, as I said, originally Curve started as a decentralized exchange for stablecoins, and which, by the way, was the very first concentrated liquidity on chain. If many people probably don't know, but all our pools do have concentrated liquidity, so we have no pools without it. In 2021, we created crypto pools, which combine concentrated and non-concentrated liquidity in some sense to allow for essentially crypto pair DEX to be profitable and more dense than a naive Uniswap 2-like approach. And in 2023, we launched CRV USD stablecoin. The biggest innovation here is in this stablecoin is soft liquidation mechanism, which allows to essentially not fear liquidations. So if you have some liquidation price being set by how much you borrowed, and the price of your collateral goes below the liquidation price, you don't actually get liquidated traditionally. You get some of your assets, or maybe all, gradually converted to Curve stablecoin, and if collateral goes up, then it converts back, so like buys back the collateral, and it appears that the process has such a small loss that you can afford to sit in this soft liquidation for a long time. Like I tried different parameters. So highest LTV probably would only be enough to sit in soft liquidation for like a day. But if you have most conservative parameters, then you can sit in soft liquidation for half a year. I actually tried that, and it was interesting. And that appears to be very much valued by leverage traders. But of course, where stablecoin is, you probably should have lending and borrowing. So we launched lending and borrowing in essentially the beginning of this year, which worked really well for assets other than Bitcoin and Ethereum. It looks like so pretty good development. And at the same time, we are like in 2020, we came up with VE tokenomics, which many projects use now. And we probably will iterate a little bit more on that, at least to the point where, allowed by immutable smart contracts, and that will happen fairly soon. So that, and another development is that we actually want to look at modifying crypto pools to somehow essentially merge the crypto pools with what Curve stablecoin gives. Apparently, that would allow to make liquidity more concentrated than before, and at least as simulations show, to greatly improve the possibility of creation of forex pools to essentially exchange between currencies like dollar and euro, or maybe others. That wasn't too efficient before, and simulations agree with that. But it appears that we actually can improve that greatly. So this is the work which is currently going on, and very, very excited about this work. And also, of course, some developments are needed for Curve stablecoin to make it like it showed that it can make a lot of fees, actually more than traditional CDPs, as it appears, due to soft liquidation being valued by a lot. And now we want to rewire it a little bit to make it grow with what it has, because it seems to be very, very much ready for that. So that's what's currently happening.
Thank you, Michael. Thank you for a really comprehensive overview. And just following up on the information you just provided. Speaking of liquidation, because Curve faced two on-chain liquidations recently. So can you share some insights on this? And have these liquidations impacted your roadmap or operations anyway?
Right. Yeah. So these were liquidations essentially with my personal stash of CRV. So it's not CRVs sitting in any treasury, nor these were CRVs which belong to the company. These were my personal ones, and I was pretty tough for me personally, but anyway, it happened. So the good part is that I had quite a fair bit of CRVs locked in governance, because to get governance power and the power to earn fees from the platform. More importantly, you have to lock these CRVs for ideally 4 years. So I have those CRVs locked for 4 years. I cannot use them as collateral, and usually had that to have my voice in the governance, right? So what happened is my liquid CRVs got liquidated, and this was a lot. This was like one third of circulating supply, it seems, and the market seemed to have handled that, but it was felt pretty bad to me. But the good part is that I still have the cash flow going from locked CRVs. So locked CRVs are with me. I cannot sell them. I cannot use them as collateral, but I can make my share of the fees from the system. And well, and that kind of saved me. So I'm now very motivated to make to build for the system, because it brings me fees, right? And probably even more motivated than before. But otherwise, financially, it doesn't seem to be affected. I am, but the system doesn't. So that's kind of that's the overview of that.
I mean, sorry to hear that, but I am glad that there are some positives that are coming out of this. But I
yeah, well,
really appreciate you sharing that with us.
Yeah, another good part, well, trying to find good things in that, right?
Silver
Another
linings,
good part for some people, as it seems, is that since I don't have those CRVs, I cannot lock them for governance power, and I've seen quite some concerns about me having too much CRVs, essentially, so that it can potentially mean controlling too much of the system. Well, right now I cannot do that. So it appears that the rate of locking CRVs for governance increased very, very much after my position was liquidated. So I think this is some reflection of this sentiment. So that's if I cannot get too much governance power, even potentially, then it means that for others it's more attractive to lock CRVs for governance power or for earnings fees or whatever.
Totally understand. But glad there's a silver lining to this. So yeah, my next question I want to ask you is, CRV, of course, has recently been listed on HashKey Global. How has the CRV tokenomics impacted Curve's growth and development compared to traditional token models like Burning?
Right. Yeah. So Curve tokenomics is fairly different from like what you have traditionally. The original idea was to have it not having one token, one vote, because if you could potentially do multiple governance attacks if you have one token, tokens equals votes models. So I brought in time into consideration as well. So if you lock your CRV and your voting power is not just your number of tokens, but number of tokens multiplied by time which is left before your tokens can unlock. So if you, let's say, locked for 4 years, or extended your lock up to 4 years, which is maximum, then you have maximum voting power. But if your tokens unlock, I don't know, tomorrow, then your governance power is very close to zero, so your votes probably wouldn't count that much. So that was their original motivation. But another interesting twist, which I didn't think of much, was economic consequences of this. And actually, because locking for 4 years gives you maximum earning power as well as governance power. It appears that people, including myself, extend this lock for 4 years, and later projects like Convex, YEarn, or StakeDAO appeared locking CRVs, so essentially having lock-in as a service, where they give fees to users, but they keep governance power and vote for different sorts of cases. And those projects definitely extend the locks up to maximum all the time. So it appears that more than 50% of CRVs locked in governance are actually having locks extended forever, so they are locked forever. And having CRVs locked forever is pretty similar to burning. So this seems to be a hybrid of model where you share fees with token holders, but you don't actually share with token holders. You share with token lockers. So you have like a blend of bringing revenues and and buy back and burn. So, but instead of buying back and burn, you let people lock tokens to earn. So they are not burning, they are earning their share in the system. And it's interesting to compare this to token burn models. So I tried to do estimates on, because like recently this question appeared in community, tried to actually measure how would this VE tokenomics, where you let people block tokens to earn commissions, how would this compare to token burn in terms of tokens removed from circulation? And it appears that it's actually more efficient, at least currently. So it's more efficient than token burn on average, as it seems. And if you take over last maybe 6-7 weeks, it appears to be I think around 6 times more efficient than a buyback and burn model. So like basically locking that much more CRVs than and removing from circulation than token burn model. And I expect that those models actually to converge to the same thing over the long time, but at least currently, VE tokenomics seems to be more efficient at removing tokens from circulation than token burn. But you know, it's we still have to process the data. We have as much as 4 years of data now, as well as we have other projects doing VE tokenomics, and you know there is some research to do. But you know, beforehand, it wasn't a consideration even in traditional finance. You token burn, well, stock repurchase was a typical thing, and dividends were also a typical thing, but VE tokenomics is neither of those. So it was never studied, and we now have data how it performs. It seems to perform better than token burn, seemingly, but yeah, it wasn't research. There was no data. Now there is data, so pretty exciting to see it, and it's like an economic experiment in real life, and looks like it's working pretty well.
Thank you, Michael. Thank you so much for that insight. I'll let you take a rest. I know there's that. You know, we went through quite a lot of questions with you just now. You know, we're gonna let you take a rest, and we're gonna have some questions for the second part of our AMA today. Now it's going to be focused more on stablecoin on the regulatory and the policy side of things. So my next question, you know, I would love to get opinions, especially from Rita and Ben. You know, this first question would be about because recently we've seen regions like Hong Kong, right? Rita just mentioned RB Technologies was one of the 3 companies selected to be part of the sandbox scheme, but also regions like South Africa, Singapore, and of course large asset management companies are launching compliant stablecoins. UMB, which is part of RD Technologies, also going to issue stablecoins in Hong Kong. So I would love to first get Rita's insight on this. You know, what does a compliant stablecoin mean for just everyday users? You know, what are the differences between a compliant stablecoin and the currently more established options like USDC and USDT?
Thanks, Larry. So first of all, the backdrop of this is generally compliance and regulation is becoming a thing in crypto, right? So various jurisdictions are rolling out regulations on various sectors in crypto, including exchanges, stable coins, OTCs. So generally compliance is becoming or regulation is becoming a thing in crypto. I think we would all agree on that. And in terms of comparison, I think it's not like, I mean, some of the tokens you just mentioned, there are, some of them are also getting regulated in some jurisdictions as well, right? So that's the background of that. So generally regulation is becoming a thing. And Hong Kong is sort of one of the jurisdictions that's pushing really, really fast and hard on this. Hong Kong basically end of 2022 sort of announced the policy statement of on development of a digital asset in Hong Kong and wanting to build Hong Kong to be the next global crypto hub. So ever since then, the government has been rolling out various regulations on exchanges and stable coins. So I think that's a backdrop of this, and RD has been sort of at the forefront of this. So we have been very publicly and actively advocating for stablecoin regulation in Hong Kong, mainly because we believe the market is demanding more sort of stablecoins that has regulatory clarity. So Hong Kong, has always been a traditional, financial hub and payment hub and trading hub. So lots of payment flows flow through here because it powers the largest export market in the world, right? So so lots of payment flows, like the trade export import companies are using are hoping to use stablecoins for cross-border payment, for example, because it's much faster and cheaper than traditional rails. But the problem with that is if for companies to to bring the stablecoin, whatever stablecoins they've received back to Hong Kong, and that stablecoin doesn't have regulatory clarity in Hong Kong, it just means it's much harder and much much more difficult for them to off ramp to fiat, right? So that's why we think we believe there's a demand for compliant stablecoin in Hong Kong to really bridge those volume in Web 2 or in traditional finance into Web 3, because the obvious advantage blockchain powered money can bring to use cases such as cross border payment. So I think Hong Kong is kind of like leading the charge in terms of stablecoin regulation in the world, and hopefully we can soon like within the sandbox start to test some use cases including cross border payment, and hopefully there will be licensing stablecoins very soon in Hong Kong.
Thank you, Rita. Thank you for that great insight on what we can expect, and what users and institutions alike are going to benefit from this a compliant stablecoin. Ben, do you have any opinions, feedbacks on this topic, especially coming from an exchange perspective?
Yeah, no, thanks. And I was just realizing something. It's a little bit off topic, but Michael, on the Curve side, I was just going back and like checking volumes on Curve, and I was remembering back when the user interface was like a Windows 3.1 type of user interface. So it's kind of cool to see like over the last over the last years how a lot of kind of the UX and UI around crypto has been kind of steadily changing. So I thought that was kind of fun to remember back to the early days of Curve. But on yeah, just in terms of the compliant landscape for stablecoins. I mean, I think we've always thought about this a little bit differently, rather whether it's stablecoins or whether it's other assets, whether it's trading venues, which is, I think, a lot of if you look at how crypto started in day one, it was essentially you look at Bitcoin, right? It came out of an era where people were really distrustful of financial institutions, right? You look at financial institutions, you say, okay, look at this, look at the level of irresponsibility, and because of the level of irresponsibility in financial institutions, we've gotten a lot of inflation, right? You look at back in 2008, and then that era. So I think when people think, at least in our industry, right, and I think there's several different types of user profiles. One is you have people who generally want to provide financial services worldwide using technology in a way that's more responsible and more inclusive. And if you look at a lot of kind of the first generation of DeFi and decentralized finance and decentralized technologies, is that's really kind of the premise and the point, right? Is let's just get the tech out there and let's make it transparent. Let's make real-time settlements fast, and let's just get it out there. And regulation in those days was kind of seen as a burden. And because of a lack of regulatory clarity in kind of the early days, right? Let's call it early days of DeFi, let's say kind of let's say like 2018, 2019, it was kind of maybe like pre-era. Then you had kind of 2020, 2021, and then more recently. And kind of that early era, regulation was definitely a little bit more of a burden because things weren't clear. People were like, okay, well, even if I wanted to design something that was, whether it's a stable coin or whether it's a trading venue, whatever, even if I do want to design something that is quote unquote compliant or regulator friendly, the clarity isn't there, and it just still costs a lot of time and money to do so, right? I think one of the really good examples of this, again, not a stable coin, not a trading venue, but a crypto asset that tried to be compliant was, if you look back at the case of Blockstack and Stacks back in, I think, 2020 or so, 2021, that team went and really tried to go down the compliant path with the SEC. I mean, I'm not sure if everyone in this AMA remembers, but Blockstack was one of the first companies to, I think maybe the only, Web3 company to kind of go down this path of getting a regulation A+ offering approval from the SEC for STX, and they went down that route and they got it, but they spent millions of dollars on legal fees, right? And at the end of the day, a few years later, they also, because the overall project decentralized, they had their own justification for not needing to be a regulated asset anymore. So it's really, I give that example because in the early days, right, a lot of regulation was about well, how relevant is this regulation to the project? How relevant is it to the way trading platforms actually perform? And people were just spending a bunch of money and not necessarily getting the results they wanted. Whereas if you look at today, right, you look at 2024 and now coming closer to 2025, is arguably, you could say, whether it's in Hong Kong, whether it's in the EU, or whether it's in other smaller city states and smaller countries worldwide, is regulators are generally trying to find the balance between how do you manage counterparty risks, and how do you manage all these different risks when it comes to blockchain based financial intermediaries and blockchain based projects, while ensuring that the space can thrive and innovate. And I think what's really interesting from my vantage point, being in this intersection of technology and also regulated financial services for a long time, is it's really been interesting to see how different regulators in different countries are trying to approach this issue, right? And it's you see different cultural differences across the world, right? Some folks are really trying to skew towards supporting innovation and trying to make the regulatory framework flexible so that innovators and entrepreneurs can build products that actually deliver a lot of the values of decentralized financial technology. And I think in those cases, you've seen in those types of countries and jurisdiction, there's a little bit less like local domestic risk, just given either the size of the populace or kind of like that local populace's familiarity with things. And then you see other jurisdictions which tend to be a little bit more conservative. They might come out with a clear regulatory framework, but in terms of the products and services that are allowable and the ability for users and consumers to make their own choices, sometimes that can be a little bit limited. So, and I think it's really hard to sit back and say, okay, which country is taking the best approach or which jurisdiction is taking the approach. I think each country and jurisdiction's regulators really make their own decisions based on the interests and needs of their constituencies. So I think it's really kind of a case by case matter. I think what's most interesting, as you look this year, I think the biggest topic of this year has been, in the case of compliance and regulations around stablecoins, obviously has been in the EU around MiCA. June 1st, 2024, that legislation became effective in the EU, and I think there's some interesting things that might come out of the U.S. I mean, the U.S. has been around crypto policy has been hat off to some of these people, right? There's a lot of folks that have been working very hard behind the scenes to help push U.S. crypto policy in the right direction. I think the presidential election that's coming up this year, as everyone knows, is going to be super important signal to where U.S. crypto policy is going in the future, especially around stablecoins. And yeah, I think maybe just as a pausing point here from HashKey Global's perspective, and from the perspective of other trading venues that want to trade assets. If you look at the EU's policy, I think it's you're going to you'll probably start to see, and this will probably be true in Hong Kong as well. Is I think if you fast forward 2 years, 3 years into the future, you're probably going to get to a point where a lot of the majority of exchanges are the majority of centralized exchanges are licensed or regulated in some form, and those exchanges and those centralized exchanges who are regulated or licensed are going to be the ones that have the most stable and robust fiat currency on and off ramps, like through bank transfers and also obviously through credit card and debit card payments. And potentially what you could see is the only stable coins that are able to be kind of listed and thriving on those platforms are those stable coins that are compliant some way in some regulation somewhere. And it's going to really depend. It's hard to say there's one overall blanket approach to this, but if you look at a global exchange like HashKey Global, what you could see over the next 2 or 3 years is, okay, let's say this is an exchange that is licensed in multiple different jurisdictions, has users in multiple jurisdictions where it's licensed. Different jurisdictions might have different requirements on what stablecoins are offered to those users, right? So if you look ahead in the EU, any licensed regulated trading platform that's operating there next year, if they want to be offering stablecoin trading pairs to their users, they're going to have to be stablecoins that are issued by an issuer that is compliant under what MiCA requires. And I think as of right now, I think it's only I think the most relevant asset in that bucket for the EU is probably Euro C, and I guess USDC in the future. So just to summarize here, I think the landscape around compliant stablecoins, and I think it ties directly to both regulations for issuers, but then also regulations for trading platforms that would be providing trading of those assets.
Thank you, Ben and Rita, for that really comprehensive overview on the perspective of compliance. Michael, I just wanted to ask if you guys have any take on this. Does Curve have a layout plan for compliance in terms of the stable coins and tokenized assets?
Yes, so I would say I view Curve as a neutral place which can be home for any sorts of assets. For example, Ethereum itself doesn't have any special compliance related features, but let's say if you take STBT, which is like a yield-bearing stablecoin, which is tokenized T-bills, it's a compliant asset which only allows certain users to interact with it, whoever passed KYC, and it does have pool on Curve, and pool is exactly the same as other pools, so their compliance mechanisms are embedded in the token itself, and that works. And well, I mean, I can imagine in certain situations some special pools might be needed for compliant assets, but in this case, it was just a very standard pool, and compliant asset is just working there. So that seems to be good. But of course, the DeFi community is not yet into compliant assets. If you have an asset which has certain restrictions and no restrictions at all, people usually choose asset with no restrictions. But at the same time, if you take things like USDC and USDT, they have block lists, for example, and that probably helps them with compliance, and people are okay with that. So but in any case, whatever the path compliant assets would take, that seems to be compatible with Curve. As for national currencies being seen as compliant assets, I think they work very well as on and off ramp from DeFi, or maybe DeFi can be seen as infrastructure which appears between entries and exits. Today we have only essentially only USD entries and exits from DeFi working. Well, a little popular, but we have euro appearing, and maybe we will have other currencies soon appearing, maybe Hong Kong dollar, and that would be pretty exciting when it takes off. And like these gates, like the entries and exits from this free DeFi world can be, of course, gated and compliant, but that's probably okay. So it's still like the existence of compliant stablecoins probably would allow to connect traditional finance to DeFi and have it embedded so that maybe users of traditional finance wouldn't even have to think what's inside, but maybe what will be inside will be actually DeFi. So that's the idea I have about where it's going.
Thank you, Michael. First of all, I would like to apologize. I'm out for a conference and I just got kicked out of my my meeting room, and so my background is going to be a little bit noisy. But I'll try to speak a bit louder and keep my mic muted when it's not necessary. So, thank you, Michael, for your feedback. And I want to turn the attention back to Ben, because Rita mentioned a little bit earlier. With the stablecoin, compliant stablecoin coming out. It's going to offer new opportunities for new users being onboarded to Web3. And I just wanted to hear from your perspective, Ben. With the increasing focus on compliant stablecoins, how is HashKey Global positioning itself to support and integrate these new assets within our platform?
Yeah, great points, right? So, what's what are we doing differently to integrate new compliant stablecoins into our platform, or just new great digital assets in general? I think one important point that I want to make here, and I think just based on what Michael said, was users are going to go wherever the frictions are light, and historically, if you look at regulated centralized exchanges, and when I say regulated, this is a very, very important point here. When I say regulated, I don't mean regulated under financial crime regulation, which is what the majority of centralized exchanges are regulated are. What I mean when I say regulated centralized exchanges, I mean exchanges that are regulated under financial market regulation, right? So that means regulators require us as a trading platform to conduct ourselves and manage ourselves in a certain way that protects the interests of users and customers in a better way. And there's just so many factors to get into, but I think if you boil it all down, what is important about a regulated centralized exchange that you don't get at a number of other exchanges is really just asset security, right? Whether it's all these things we do around minimizing operational risk, or all these things that we do around making sure that when we custody client assets, that we make sure that they are remote from any bankruptcy risk of our exchange. I mean, these are things that if FTX would have done, nobody would have lost money in that exchange, right? So, the important thing to keep in mind, and again, going back to Michael's point, is that users, no matter how secure we might keep client assets, and no matter how secure we might keep users' assets, if we don't make it easy for users to trade, and if we don't reduce the frictions, people won't come over to these types of exchanges, right? So, I think when it comes to how we view the frictions of using regulated centralized exchanges, I think there's a number of frictions. One type of friction is limited products and services, and traditionally that's been a huge friction of using safe, regulated, centralized exchanges, because the majority of jurisdictions out there that regulate exchanges like this tend to be quite restrictive on products and services that you can offer, right? Whether it's stable coins, whether it's other types of crypto assets, whether it's other types of services. So, if you look at HashKey Global, it's very unique what we're trying to do, because here what you have is you have an exchange that is segregating very legally, right? It's segregating client assets from the company assets, which makes it much more secure in terms of ensuring that there's no exposure that clients have to the bankruptcy risk of our exchange. And there's a number of other things around security protocols and things like that that we do to make sure that client assets are secure at all times. But just going back to the point that I was making, if you look at what HashKey Global has been doing since it launched on April 1st, kind of the first week of April, there's no other exchange. I think there's several points there, right? I think we've been the fastest growing compliant exchange in 2024. And we've done that through offering a number of unique products and services that you generally don't see on regulated centralized exchanges, right? I mean, perpetual futures, besides Coinbase, there's no other licensed exchange out there that's providing perpetual futures trading under a licensed framework, right? And Bermuda is very unique worldwide, and it's one of the only regulators that actually has a license framework for derivatives. So there's actually like due diligence that goes into, there's actually been a lot of regulatory due diligence into how we designed our perpetual futures and getting that and making sure that that's properly supervised, right? So it's very rare to have any type of regulated centralized exchange worldwide that's protecting user assets in the way that we are, offering things like perpetual futures. Also similar in that side of things, offering things like launch pool. And these are types of services that users are traditionally used to getting on a number of different unregulated, unlicensed exchanges worldwide. And I think it's very, very important, going back to this idea of frictions, that we are able to, as a regulated centralized exchange, it's very important that we are able to both protect users' assets, keep users' assets safe, and provide them with a number of different listings of products and services that allow them to trade and get the same trading experience that they're used to getting on other exchanges. So as a long story short here, I think when it comes to listings of regulated licensed stablecoins, as well as HashKey Global expands its licensing footprint into a number of different jurisdictions and regions, it's going to become more and more important for us to be allowing access to stablecoins that are issued by issuers who are licensed accordingly in those jurisdictions. And I think with regards to where we are right now in the world, just in terms of regulatory trends around stablecoins, actually middle of 2024, if you look at the first region of the world that's really going to be kind of mandating that trading platforms are only offering trading of licensed stablecoins, the first region that's really going to be mandating that at scale is going to be in the EU. And although, as I just mentioned, the EU has already made effective its regulations around issuers for stablecoins, the trading platforms that actually trade those assets won't actually be licensed until 2025 in the EU. So I think what you will definitely see in 2025 is you'll start to see the focus around regulation for stablecoin issuers, and these clear regulatory requirements for stablecoin issues start to become more and more important from a business perspective. But that said, I mean, back to Michael's point, I mean, you look at the comparison between the two leading stablecoins out there, USDT and USDC. I think you've got USDT at around maybe like $120 billion in market cap. USDC, I can't remember, but I think it's around like 40 to 50 or somewhere in that range. And you look at it from the perspective of Tether, right? I mean, I don't want people to get me wrong. I still think Tether as an asset, right, in terms of the kind of the euro dollar market, is actually has a huge amount of successful product market fit. I think what is yet to be seen is how is all of these regulations around stablecoin issuers going to impact Tether's market share going forward. Maybe it just continues to increase, and maybe it doesn't get affected. Maybe it does. I'm not sure yet. I think what you will see is, I think as I think what you will see is I think you'll start, I think you'll begin to see USDC and EuroC out of Circle. I think those will continue to grow. I think the overall stablecoin market will continue to grow. I think the big question is, as the overall market for fiat currency and government bond backed stablecoins increases, how the percent share of that market between Tether or USDC, assets issued by RD Technologies, et cetera, how the percent share across the different players changes, in relation to regulatory trends. So I think it's an interesting space to watch.
For sure, and it's for sure there's going to be a lot of development that's going to happen quite rapidly. I think in the months ahead. And one of the things that Rita mentioned earlier about one of the advantages, I guess, of having a compliant stablecoin in the case of Hong Kong is, of course, being able to onboard more perhaps traditional investors or users into Web3. So I wanted to ask the next question to Rita. How do you see stablecoins integrated with traditional financial system, and what compliance measures are necessary for this integration?
Sure. Thanks, Larry. I think our view, our RD has always been, the stablecoin market the cake can be much, much bigger. So actually for us, the priority is not to take market share from all the existing stablecoins. It's more like make the cake bigger. But how is to bring, like I said, the more traditional finance volume into Web3. By going through the sort of compliant route that provides more regulatory clarity, so that more regulated Web2 institutions can come into the space. So I think I completely agree with Michael on how do we integrate it is actually to leverage the advantages offered by Web3, by blockchain, by crypto, and make traditional finance better, right? Ideally, in a way that traditional finance doesn't even need to feel they're going through a certain friction to go into Web3, right? So that's the ideal situation. And in terms of why we think the cake can be much bigger, some of the research report actually estimate the stablecoin market can grow to $3 trillion market cap in 5 years. Up from the current $150 billion market cap, right? And how? It's basically, if you look into some traditional financial market, like cross-border payment, that's $1 trillion market. FX market, that's $1 trillion market. And traditional capital market, that's also very big market. So if we can bring in just a fraction of those market into Web3, the cake can be much bigger. And just on I think the currency market was mentioned a few times here. Michael mentioned that too. I think that's a very interesting example here, right? So using some of the technology we have in Web3, for example, AMM, there's various research on how it can actually make traditional FX market much more efficient, combined with the advantages provided by blockchain that can make settlement faster. It will greatly reduce the friction in traditional FX market and reduce the FX settlement risk. So I think we are already gradually moving to that space, and I think the percentage of all this traditional market like cross-border payment or FX market of using blockchain to solve problems in this traditional market, the percentage will just get bigger and bigger, right? Using stablecoin to solve cross-border payment problems, to solve FX market problems, the percentage will only get bigger. So that's why we think the cake can be much bigger. And we're launching Hong Kong dollar pegged stablecoin to start with, and that is actually specifically very interesting for that on-chain FX narrative, because you need different currency pegged stablecoin to create that on-chain FX market, right? So I think that's why we think there's various ways to integrate traditional finance into Web3, and that like we can make the cake much bigger. And what's required from sort of compliance point of view, I think why we need regulation is mainly, I think for stablecoin specifically, is just to provide more transparency and credibility, right, to the issuer, with sort of the endorsement from regulator and from, let's say, reputable third-party auditors, right? So I think what matters here is the reserve asset attestation, transparency on the composition of the reserve asset, and one-to-one backing, fully reserved backing of the reserve asset. Those are important things, right? Now, with the Hong Kong regulation specifically, the regulator is very clear on prohibition of interest payments. So this stablecoin issued in Hong Kong is not allowed to pay out interest to the stablecoin holder. And that's, I know, is sort of there are different trends going on with different stablecoins around the world. I think the Hong Kong's framework is good for certain use cases such as cross-border payments, FX market, because without paying out the payment interest on the stablecoin itself, I think it creates more incentive to use the stablecoin in question as a tool for exchange of value, right? Instead of all the things. So I think the what matters here, with compliance or with regulation for stablecoin is transparency and credibility.
Yeah, I actually totally agree with what you said, and it's I think just wanted to add some thought which I had after listening to this. Actually, like what compliant stable coins would do, they would enable composability of traditional finance and decentralized finance. Like why DeFi is so successful is because it allows for composability between different products without those products actually asking for permission to do that. And the same thing can happen between traditional finance and decentralized finance. If compliant stable coins were not created, and let's say if no one worked on those, then I think still the world would have found a way to hack through it, but it would be a pretty uncontrolled way of transformation of financial system. And the compliant stable coins actually can enable more traditional, more controlled way to transform the financial system. So it's not like someone is hacking into it and replacing it with something else. It's more of an evolution play. And that's what compliant stable coins do. So in principle, for governments, if they think about that, it's a no-brainer to have these compliant stable coins enabled, and I think that DeFi is the future of the whole financial system. So not that it will take a part of it. I think it will be embedded in everywhere. It's not that it will replace it, but probably it will modify it, and the future will be probably unthinkable without decentralized finance. We are far from that, but I think yes, compliant stable coins could be what enables this transformation.
Thank you so much. Thank you so much, Rita. Of course, Michael, for that insight. We are coming to the 1 hour mark. Of course, our speakers are very busy and taking the time to really appreciate you guys taking the time to join our Twitter space. But as the tradition goes on all our Twitter spaces, we always end with sort of a prediction or something we hope for the future. And in the case for today's topic, it's going to be around stablecoins. So I wanted to just quickly ask all of our speakers today. Maybe we, Michael, you can get us started. But what do where do you see stablecoin, the market of stablecoin headed in the next 5 years, especially with the backdrop of increasing compliance and regulatory scrutiny?
Well, it's hard to say, of course, but yeah, I think the market will change a little bit. So yeah, maybe it's not even the players which we see today, but maybe there will be new players appearing, and maybe there will be some CBDCs at some point, not necessarily the commercial stablecoins like USDC and USDT. And of course, I think we still will have a bunch of decentralized stablecoins. I think we probably will see more stablecoins rather than less stablecoins, and obviously bigger market capitalization of all.
Thank you, Michael. Thank you. And Rita, what do you think is going to happen in the next 5 years? Of course, if things are just happening now in Hong Kong, and you mentioned the pie is going to get bigger, what do you think we are going to be at in the next 5 years?
Yeah, I agree with Michael. I think it will be just like there will be more options for different types of customers, different segments of the market. We are focused on the institutional side of things. Like I said, we want to bring in more Web2 financial institutions into the Web3 world through our compliant stablecoin issued in Hong Kong. But I believe there will continue to be more options for different segments of the market. I think the world is already merging. We always talk about Web2 and Web3 in the world, but I think the two worlds are already merging together. The line is getting blurry as we speak. I was just at the forum in Switzerland where central bankers are on the same forum with Uniswap, right, talking about how blockchain can make currency market more efficient, right? So I think it's already merging. We can definitely bridge more volume from Web2 into Web3, and that's what we're hoping for. And in terms of 5 years, I mentioned the research report. It's predicting 3 trillion market cap stablecoin. So that's what we are working for here.
It sounds really, really exciting, and definitely a lot of changes to come. And Mike, Ben, finally, would you like to close us off with your insights on what's going to happen in the next 5 years in relation to stablecoins and compliance?
Yeah, just the final word. I'll keep it short and sweet here. No, I think within 5 years, I think it's quite clear. I think just I think consumer and retail usage of stablecoins. I think we won't even call them stablecoins anymore. I think they'll just be. I just think at that point in time, if you look at kind of using a digital wallet right now, and the fact that you kind of go fiat directly into that, and then that digital wallet is kind of using traditional payment rails, whether it's credit card, debit card, or whatever, right? You look at like Revolut in the EU or like other types of digital wallets. I think in the future it's just going to be like seamless, and people are not even think that there's a blockchain based like stablecoin that I'm topping up into in my digital wallet that I'm using to pay for various different things worldwide, and interact with various different apps online in a programmatic way. So I just think the integration of a unit of fiat value as a stablecoin into the daily like offline and online economy is going to become more and more pronounced over the next like 3 to 5 years. And as a byproduct of that, that's where you're going to see that huge increase in the stablecoin market, right? Because people will be on ramping from traditional fiat rails and banking rails into that that digital wallet, kind of that offline online payments ecosystem powered by stablecoins. And I think that's where I see things going over 5 years. And I think the on and off ramps into that from fiat traditional banking rails into that kind of the Web3 like digital payments rails is going to be provisioned by regulated entities like HashKey Global.
Thank you so much. Thank you so much to Ben and to Rita and to Michael for spending the time with us for what I think is a really insightful conversation. I do again for the noises that is coming out on my end. But I really appreciate for the time you guys are taking to have this really exciting conversation. And of course, I'm really looking forward to things to come in the next 5 years or even in just the next few months. If you haven't yet, for sure, follow RD Technology, follow Curve Finance, of course, HashKey Global on Twitter. And if you haven't yet, check out HashKey Global, global.hashkey.com for a compliant and safe trading experience. Again, thank you so much, Rita, Michael, and Ben, for your time. Hope to be able to see you guys again, especially maybe in 5 years. So we can revisit some of the predictions we made. Thank you guys so much. Have a great day, a great evening, wherever you are. Thank you.
Thank
Thanks,
you.
guys. Bye-bye.